So really excited. I know it's day 3, so we'll try to keep this as exciting and engaging as possible. And I would encourage questions as well throughout the conversation. I suppose one of the things that was interesting to me, kind of when I saw the group of folks that was on the panel with here today, was just the diverse background. I think that everyone brings in a different perspective to the whole ecosystem. So maybe set some context. I think it'd be helpful for everyone maybe to do a brief introduction. So yeah, I'll start with you.
I'm Aejaz. I'm one of the co-founders and CEO of Breach Insurance. I'm in my 12th year of insurance. Prior to founding Breach, I spent 7 years here in Boston at Liberty Mutual, building new products, entering new markets, and then left Liberty in April 2019 to found Breach in my 2nd winter. Yeah, glad to be here.
My name is Yasir Bugrara, co-founder of StateSpace, background in safety-critical software simulation and engineering. And StateSpace does some smart contract simulation for technical and economic security and risk analysis.
So Thom, Global Chief Compliance Officer at Moonpay, which is a non-custodial on and off ramp for crypto as well as NFT checkouts. I'm also an adjunct professor at Boston University Law School, where I teach crypto regulation and payments. My background, I'm a recovering attorney, but I've been in the crypto space since 2018, and prior to that was in TradFi. Happy to be here.
Patrick O'Kane. I'm a general partner at RW3 Ventures. We're an early stage crypto venture firm. I started my professional career with the intelligence community. I was focusing on counterterrorism, financing issues, and other national security objectives. In 2012, I went to the DOJ and started to build out some of the initial crypto investigative strategies at the DOJ. Scaled that for about 6 years, then went to KPMG, where I helped to build out the crypto asset services practice. And there we did everything you could imagine a Big Four does, but it was all geared towards the crypto ecosystem.
Very cool. Mike, we should talk. There's a lot of stuff, I think, in our collective backgrounds. So guys, just to start, I'm interested just from a risk perspective, kind of what are each of you kind of dealing with in your kind of day-to-day jobs in terms of, you know, just risks that you see in your particular areas and kind of strategies you're deploying to mitigate those. So yeah, you want to start?
You know, for us, the risk is quite literally our business, and you know, there's corporate risks that we have to manage, and then there's outside risks that we assume. On the corporate side, just like everybody, we're dealing with compliance, we're dealing with overall business risk, we're dealing with cybersecurity risks. We can be under attack just like anybody else can, just like a platform can. So mitigating that. And compliance is the biggest one, right? Because we're regulated both in the US, we have to comply with all Department of Insurance regulators. There's 50 plus DC. And then we have an insurance carrier domiciled out of Bermuda that allows us to do a lot of non-US stuff that we're doing. So it's hard, but I think it makes it quite defensible because we do stay compliant. On the operation side, you know, we're looking at, you know, any kind of company that's here and working with any kind of company that would be here to ensure things like custody, ensure things like payments, wallets, exchanges. So there's a wide number of risks that we encounter in crypto, and you know, we have to look at every single aspect of it, from somebody being able to pay yeah. to actually underwriting risk, assuming risk, and paying claims.
Yeah. Yes, sir.
Yeah, you know, I spend a lot of time on the technical side, but that's, you know, primarily because, you know, in the crypto world and digital asset world, you know, businesses are making claims about their business, what actually they're delivering to their users and clients, and that's in the crypto blockchain world. That's represented in the code. So there's an inherent risk, you know, between these two, in that, you know, how can you ensure that the code is actually compliant to the claims that are being made by these businesses? So ultimately, there's a whole host of risks that are inherent within these smart contracts, and in in the ecosystem, especially in DeFi and in the broader blockchain ecosystem, you have a systemic risk around, you know, code development, and that one smart contract is composable with another contract and another contract and another contract. And that just means that you have these developers who are writing their own code, and they have to understand how it works, but they also are able now to connect to other people's code that they did not author. And that's an inherently difficult thing to do, is to test my own code using code that, you know, that's included, that has code that I didn't author, which also includes code that they didn't author. So now you have this systemic risk that's brought around the ecosystem. And what we're trying to do specifically is, how do we quantify that risk? And how can we help developers understand what that, kind of like a, I don't want to say like a risk score, but they definitely need to understand the behavior of their code. And so we're trying to, what we're doing is solving this problem around how do you solve this idea of, not just technical security across an ecosystem where there is plenty of risk, but also economic security, where you can manipulate some of these contracts for logic that these developers may have not even understood actually exists in the first place.
So my risks aren't as cool as those, but ultimately, as a chief compliance officer, I worry about all the risks, all of them, which is fun. But if you bubble them up from my perspective in supporting a business, I have to, it's the risk of losing regulatory licenses, right? The risk of losing bank partners, right? Post FTX, post the banking crisis earlier this year, as it related to crypto as well, compliance is supporting our ability is front and center in getting banking relationships, which as much as crypto is trying to separate itself from the traditional banking sector, many of the companies involved are very much tied to traditional banking to support the businesses. So if I dive down on those, they kind of break into a bunch of different ways. I like to break it into two sides. I think there's a financial crime risk, and then there's kind of core compliance, non-financial crime risk, which I think of as kind of the silent killers. Financial crime risk, AML, counter-terrorist financing, sanctions, fraud, these are all kind of the front and center, very sexy things that are super dangerous in the end, right? That is what people often, naysayers think about from crypto is that it is used for financial crime. And undoubtedly all finance is used for financial crime in some way, shape, or form. But our job in an institution is to set up safeguards to prevent folks from getting into those, identify any bad actors in our institutions, and ultimately report those to law enforcement to take action. So that's a big part of risk that we need to control in a lot of different ways. On the other hand, regulations cover a lot of other things: consumer protection, cybersecurity, and information security. And so making sure that we're building out compliant programs to address customer complaints, to ensure that customers are getting the right disclosures and understand how our processes are working and understand what to do if something goes wrong. Ultimately, regulators and banking partners, frankly, are really worried about those sides. So I worry about all of them.
Yeah. From an investment standpoint, venture investing, you have, in this ecosystem, you have all of the traditional risks that already exist in just early stage investing. It's tech risk, there's execution risk, there's competition, et cetera. All of those you can get comfortable with the right amount of due diligence. You can sort of quantify that risk. And then there's regulatory risk. There's always been regulatory risk in this ecosystem, but in this climate, it seems quite heightened. There's more or less a regulatory-induced pause right now. And historically, when we've seen that with other industries, that those sort of regulatory-induced pauses favor the incumbents. So what does that mean for startups right now and how I look at the ecosystem? It's tough to say. Maybe it means you look for businesses that can likely be acquired when one of the incumbents is faced with a buy or build decision. So that's one thing we're thinking about right now, and I think that's what founders should be thinking about. And then in terms of portfolio construction and trying to de-risk our portfolio in this environment, we like to focus on real companies that are filling very present gaps in the ecosystem, like insurance, for example. We funded Eyhab's company Breach. Insurance has always been a huge gap in this ecosystem. We fund companies that have real-world use cases like healthcare with massive TAMs that leverage blockchain technology that greatly enhances diagnostic tests, for example. And then we also look a lot at security companies and companies that are building tools to help governments get insight into the ecosystem. An example there is we funded a company called Cat Labs, and they're building a crypto forensics tool that is geared towards government investigators to identify illicit cryptocurrencies on seized hard drives, seized cell phones, things like that. And I think plays like that not only will help the ecosystem, I think it's really important that governments have the right tools to police this ecosystem. And until they do, we won't get favorable regulatory outcomes. It's somewhat de-risked because that's clearly needed in this ecosystem.
Thanks, everyone. Some really interesting ones there. I think one thing, Thom, you brought up there, and maybe it's not fully appreciated, actually, is the challenges that a firm operating in the space has simply in getting and maintaining a banking account, right? Can you elaborate on that point and some of the challenges that are associated with that?
Yeah, absolutely. I mean, if we roll back, I think that was April. I tried to block it out, but I think it was roughly April. Two of the biggest banks that support fintechs, but in particular crypto companies, saw bank runs. Right, we had Silvergate Bank and Silicon Valley Bank, and for a large number of companies, right, what does that mean? What are you using these banks for? Twofold, right? One, you're using them for your corporate accounts, so all of your operating capital, paying your vendors, paying your employees, paying your rent for offices, running your business. The second side is if you are holding customer funds, keeping your customer funds, right? Being able to, if a customer comes and asks for their funds back, being able to give it to them. So again, an essential part of running what in that sense is kind of a custodial business. Without those, you're sunk. Your business kind of shuts down. And so what happened at that point was everyone panicked. Most companies were using one or both of those, but no other banks. So either their funds were frozen at Silvergate or Silicon Valley because they had nowhere else to put them. The thing about opening a bank account for a business, in particular, a business period, is very hard. Anyone who's tried to do that, it's not a short process. If you're a crypto company, it is extremely hard. It's not impossible, but it takes a long time. And so companies who were not thinking ahead to this risk were left out in the wind, right? Whereas other companies were able to kind of migrate. And what we're seeing right now is, while we do hear a lot of news about large, global national banks being involved in the space, the reality is they don't bank many companies. So those are called tier one banks, right? Those are the creme de la creme, at least for security standpoints. So what you're left with is a lot of regional banks. And so there are many regional banks who support the crypto industry, which is fantastic. But they all are susceptible to this risk that happened back in April. So what you have to do is diversify, which means people like myself go along with the finance team and do roadshows to explain that our compliance program is really good, you should give us a bank account, to allow us to kind of control that risk by having options on where we keep our funds. It's something I never thought that I would do as a compliance person.
Yeah, very cool. So yeah, kind of bringing some of those points back to you. I mean, we talked about this regulatory uncertainty and all that stuff. How are this landscape or environment kind of influencing decisions you're making? And,
yeah, it's a good question because we were both conservative yet progressive at the same time. We remain incredibly conservative from a compliance and regulation standpoint because we comply as any other insurance company would in the US. We have all the licenses that any MGA, managing general agency, would have because we have AM Best rated primary insurers behind us and AM Best rated reinsurers that are behind them. So we are upheld to the highest of standards as an MGA. Similarly in Bermuda, who has reciprocity both with all the Department of Insurance regulators here in the US, as well as Lloyd's of London. Those are the three largest insurance markets in the world. We comply with them as well, which allows us to, I believe, be quite progressive from an insurance risk-taking standpoint. We believe that any company that is legally allowed to be registered is insurable, right? And we dictate then whether or not we should deploy capacity into those risks, whether it's a payments company or whether it's a custody company, whether it's an exchange, whether it's a wallet, whether it's a platform. We get to decide from a business risk standpoint if this is worthy of deploying insurance capacity into. So I just believe that what we've seen a lot of it, particularly in banking, is you see conservativity both on the regulation side as well as the business risk side our perspective being a crypto native insurer is that because we're being ultimately conservative on the regulation front, it allows us to be progressive on the business front. But that's just my simplistic view of the world that we live in.
Interesting.
I mean, I love that. I love the way that you just described that, and I think that that's especially post FTX, post last year. Let's just say post last year. That's how I think companies are ultimately going to be successful. Is you have to, you have to abide by the regulations. You got to get the licenses you need. You got to be conservative, and there's a flight, I think, to to quality in that regard.
Correct.
But I think it's a really interesting angle that allows you to take some risk on the other side and be progressive. And I think that's
it resonates. It resonates really well both with regulators as well as the business the industry that we're in, because people aren't talking like that, right? Yeah. Particularly people coming from these legacy industries like banking and insurance. It's hard. It's hard. I mean, even for us, we're a venture-backed startup that's domiciled here, that's got all the licenses. Even for us, like we have to do our own road shows and make sure that we maintain tier 1 banking relationships, and we're fortunate to be in that position. But a lot of companies that I know of aren't in that same position, and a lot of them are in Europe, many of them in UK, but even here in the US, it's a complicated environment being in crypto right now.
And look, I think what you're noticing here is kind of the infrastructural pieces, like what you have with insurance and Yasir, from a technical perspective, how are some of these kind of things influencing what you're looking at and doing?
Yeah, I think it's very much interconnected, and the industry is still very young. And there's a lot of traditional, thinking, even from a technology perspective, that's being applied that won't necessarily carry over so easy. So there must be some innovation in this space. We were just talking about quality, and then there's this, and also kind of regulatory compliance, and both kind of go hand in hand. And in fact, I think Dubai put out, I think the Virtual Assets and Regulation Authority, I think a few months ago, put out kind of their regulation standards, and part of that, part of their compliance requirements are auditable, traceable understanding of the technical aspects of the underlying smart contracts that enable these businesses. So how do you document a behavior of your software, right? That's something that's kind of new to the industry. It's not new to safety critical companies that are developing airplanes, right? You have one bug in an airplane engine, people die, right? So they employ very critical and very restrictive standards on how they develop their software, and more importantly, how they test their software in terms of quality. So the way that we're kind of intertwined here is that there's this quality piece that we can't risk customer funds simply by just some developer writing a piece of code. Ultimately, it needs to be secure, and honestly, when you have hundreds of millions, if not billions of dollars at stake, as we've seen with these hacks, it's absolutely critical that we enable the developers in the technical community to be able to understand that behavior. And today, that's all the ultimate gap is that they don't have the tools that are available to them to find out what they don't know. And there's this interesting metric I read in a paper, in an academic paper. Somebody did a study around they took 127 vulnerabilities or attacks that have occurred in the last year or so. Equates to about $2 billion. And so they took all of the automated tools that exist today to help discern quality of code and how it actually behaves. And of that $2 billion, approximately 200 to 300 million of it was actually automatically detected with these tools. And these are the tools that engineers and auditors that are using themselves. So leaves this gap of around well, what happens to this other 80 to 90% of funds that were hacked? How do you effectively detect those? And so you don't know what you don't know, and these are all underlying logic errors and other things like Oracle manipulation issues. But ultimately, where we're focused on is kind of bridging that gap. That 80% of logic errors and manipulation errors and understanding systemic risk is really where we're driving to. And then the last component is with all of these regulations that will come down, developers need a way to make sure that their code complies to them. So there are certain rules that you obviously code, but you need to check that they actually exist and behave in the real world, such that somebody who's whether you're insuring a policy, you can ensure that somebody needs to make sure that these compliance and regulation rules and requirements are embedded into the code. So how do you simulate for that before you go to production?
Yeah, and I think what you're hearing here is, just the maturity of the whole ecosystem that's evolving, right? And I think this check and balance between regulatory oversight and maturing in the infrastructure that we've come to be used to expect in traditional areas of the financial system are kind of starting to move more and more into this space, right? So Patrick, from an infrastructure perspective, where do you still see some of the kind of gaps, or what are the areas that you're kind of looking at from still opportunity areas for kind of companies in this space?
Infrastructure, it's tricky, and I don't think if you go down to the foundation, so layer one, let's talk about that. I don't think anyone really knows what the future holds in terms of layer ones, layer twos on ETH, and anyone that says they do, I think they're lying, because ETH has all of the liquidity still. And L2s are being built on top of it to make it more performant, but it does have a lot of tech debt, and there is functionality that ETH is not customized for, like ZK, for example. So that's why a lot of projects opt to build a novel L1 that is more performant, that more scalable, allows for more programmability, more decentralization. And it's custom built for the specific use case. So I think it's too early to tell where the gaps are in infrastructure and how they're going to be solved. So we construct our portfolio to kind of hedge with whatever way the industry takes. So that being said, I mean, all of these new protocols, there's going to be more composability. So I do think there is a space to allow for multiple L1s and L2s to coexist together, and developers can pick and choose and have a wider design space and choices to develop their applications. But it's really too early to tell what gaps exist now and how they're going to be solved.
Okay. So touch upon the topic as well from the previous panel. We talked a little bit about kind of all the regulatory climate and the uncertainty. Thom, wearing your kind of goggles or lens, where do you think things are going to, how do we see this unfold? We see some bills going through Congress and through the Senate. Do you think we're going to get the kind of the clarity we need?
I mean, I'd love to say that I'm optimistic that Congress is going to move quick, but I'm not. Now, I think eventually we will see something. I think if we didn't see something super quick after a collapse like FTX, then I think they're still going to take time. And so unfortunately, I think we're going to be stuck with some of this regulation by enforcement and regulatory lack of clarity. I think I'm hopeful that some of these legal actions that the SEC has brought against, Ripple, Coinbase, hopefully will fall in a way that provides some clarity to the industry, unfortunately through legal decision, which isn't fantastic. And so I think that's where we're going to first start to see some clarity to help, and then probably ultimately followed by some congressional action.
Yeah. Just a general question, I find as well, we live in this world with blockchain, DeFi, where we never had so much visibility and transparency in terms of the nature of transactions, right? And yet the narrative is out there that a lot of this stuff is invisible and not transparent. I'd love to kind of get your thoughts. So for example, the FTX one is a prime example, right? The movement of customer deposits without necessarily knowledge. I mean, it seems like there's still a disconnect, right, from the technical capability versus the perception of what regulators have about the whole space, right? And I'd love to kind of get your general thoughts on that. Yasir, if you want to.
Yeah, I mean, that's an interesting case, right? A lot of the rules, somebody like FTX, I mean, they broke a lot of rules, right? There's a lot of, checks and balances that were not really employed at that company. I'm not a lawyer, right? So I don't know all the details. But, from my perspective, a lot of it, if you look at, what blockchain and the ecosystem can actually do is, employ some of these rules and requirements and checks and balances in an automated fashion. And ultimately, there's a long way to go to get there because, somebody can always manipulate something, so it doesn't always feel so safe. So, it feels like FTX was all kind of off-chain, right? But this idea of bringing something on-chain, then bringing these rules and regulations together in an automated checks and balances fashion, seems like an optimistic approach.
I was going to say, I think, and Patrick and I were on a panel, I don't know, a couple years ago, and someone on the panel with us was a former SEC. I think he was a commissioner, but he said something really interesting. I think it relates to this, like not having the clarity, is if you take reasonable steps to do what a reasonably right thing, like separating customer funds from corporate assets, like you don't really need someone to tell you that that's the right way to do it, right? And so if you take that approach in this lack of regulatory clarity, more likely than not, you're going to be on the right side of the law. You may get a foot foul, right? You may technically not have done something, but that's much better than having completely violated the law. And so I think that that's an interesting guiding principle, kind of in addition to what you're saying of like using the tech.
I think it's important to keep in mind that FTX was not crypto fraud. It was just fraud and illegal stuff. It just happened to be in the crypto ecosystem. So, and that sort of thing happens across all industries, and it always will. And it just because it's in the crypto ecosystem doesn't mean that it was specifically a crypto fraud. But I do think that the governments still need better tools to fight on-chain fraud and prohibit bad actors from getting into the space. And Chainalysis exists and TRM Labs, but they're very manual, and the government has limited resources, and these companies charge a ton for licenses, which actually means it's just mostly professional services because they don't have the manpower to go through the analysis there. So I think it's important to have more automation for governments and compliance officers. And if you look at it, I went through the 2024 fiscal year budget, and it was staggering how many agencies across the board referenced cryptocurrency or digital assets in their requests for additional funding. So the governments are taking it seriously. They recognize that they need more funding, better tools, more personnel. And from the legislative perspective, there are bipartisan bills being presented. Where that falls out, it's really uncertain right now. We have an election coming up, and that's going to kind of potentially change the playing field. But I do think something is going to come down the pipeline in a meaningful fashion. When that happens, unclear.
Well, just quickly before we close, I wanted to throw it out to questions. Anyone?
Great panel. Thanks, everyone. Just curious. I'm wondering how being immersed in compliance in this space has changed your attitude related to taboo topics in TradFi. So in particular, there are so many parallels between the crypto space and the cannabis space. It's unbelievable. And my opinion is, since the regulators are treating our industry like shit, and they don't have much respect for the cannabis industry either, are any of you looking at things differently? And just as an example, Tier 1 financial institutions are still screening potential employees for weed. It's legal in Massachusetts. I know it's not legal nationally. But I'm wondering, does misery love company? If these are two industries that are being battered by the regulators, do you see any kind of symbiotic relationship or karma between the two? And would you encourage a new thought in relation to taboo topics?
I mean, who wants to take that one?
I'm happy to talk about it a little bit. I think, ultimately, yes, like working in this space has made me as a compliance professional, right? You start out as, relatively conservative, but working in this space, I think, makes you think outside the box, makes you be creative and problem solve some of these things. And so I think there is like a recognition that there are other industries. I think realistically, I have a tough enough time getting bank relationships as a crypto company. If I'm a crypto company that's like focused on, cannabis, that's like 2 strikes before you've even walked in the door, right? So I think there is, I think there's obviously symbiotic relationships, right? There's a movement of value between, in this industry that can support industries that are unbanked. I think there's still some forces that, it's hard to get out from the thumb of those.
Yeah. We got one more question.
I had a question on, I guess, acquiring, banks to make you have an account. For like smaller businesses, how do you acquire an account? Is it based off, I guess, your reputation, or because obviously you want more funds diversified around different banks? So I was wondering how smaller banks, or smaller businesses, are able to get accounts from multiple banks.
Who wants to?
I'll talk to you afterwards.
Yeah. It's possible. It's hard, right? You got to get your ducks in a row. You got to probably take a couple losses before you get a win. But it is, having a defined plan, having, you got to make them believe in the business that, it's going to be successful and it's going to be safe. I think that's a big part.
I'd say also walk into the conversation like you are underwriting your business. So you may not want to tell them everything. Not to say you have to hide things, but acknowledging that a certain bank wants to do business with you, but can't participate in certain activities or doesn't want their clients to participate in certain activities. You have to acknowledge that, and maybe you punt that part of your business for 2 years down the road until you have a track record and you're doing something very, very basic. Like, hey, right now, when I first started, I was an insurtech. That's it. Right? I didn't need, it was too much information to be like, hey, we're doing crypto, and we're like, it wasn't that yet, right? We were just focusing on building novel, emerging insurance solutions, regulated, and that was really it. That's all they needed to know. And it's not that I was lying, it's not that I was misrepresenting my business, it's where we were at that time. So contemplate that, and if that makes sense, try to take that approach, and then as you get further down the road, then you've got a little bit of, hopefully success to be able to say, hey, now you might want to, I'm exploring this other thing, and get out in front of it. Don't hide it until they find out. Get out in front of it, and then manage your business risk that way. But
I think that's
worked for us.
I think that's a really good point. Labeling in this industry is really terrible. So how you frame what you're doing, I think, is very important and needs to mature in our industry. For example, ICOs. It's a play on the IPO, which the SEC clearly regulates. So whether that would have changed anything with the outcome for those ICOs, probably not. But why give this industry more scrutiny because you're putting scary labels on things? And it always strikes me when at some point, we're very early still, and everything, we look at blockchain companies and crypto companies, and eventually those labels are going to kind of fall away, and it's just going to be a company. Traditional companies using traditional tech don't pitch their company saying, yeah, we use TCP/IP protocol and we're an AWS cloud-based solution. No, that's just the back-end tech that allows all of this work, and really the consumer doesn't need to know the rails. And I think once we mature a little bit, the blockchain and all of this lingo that we use that kind of scares people right now will hopefully go away, and it will just be very mainstream technology, and you don't even have to talk about the underlying tech and infrastructure.
I think that's a great point. We've made the technology the center of the conversation. Like when you run your MasterCard, you question what technology they're using, right? You trust it works. And I think we're hitting that evolution, right? We're going through that transition, so it's really exciting. I think we're out of time. I want to thank my panelists. Great conversation, so thank you. And thanks everyone for your time.